All right, guys, so I wanted to bring up a quick conversation starter. Does skipping a higher interest mortgage mean missing out on appreciation? Will it cost you more waiting out the housing market? I've seen this all over Facebook. There are many sides and opinions when it comes to predicting the housing market right now, especially during times like this. Now, on this channel, we aim to provide you with both sides so that you're better equipped to make the most informed decision for yourself when it comes to your personal financial future. It is with this in mind that we have started what we call Conversation Starters as a series. Now, this series will consist of short videos describing particular viewpoints on the housing market or other various relevant topics to your finances. And as the name implies, it's our hope that we want to get some conversation started in the comments section on these videos to further aid in separating the wheat from the chaff, and thus we can all become better informed in the process. Now, in today's video, we'll take a look at how skipping a higher interest mortgage right now could potentially cost you more in the long run. At around 7% for a 30-year fixed rate mortgage, interest rates are higher than we've seen in years and years. And this is justifiably causing would-be homebuyers to shy away from purchases due to the impact of those high rates on affordability of monthly mortgage payments. However, there are a couple of factors that may indicate that an opposing approach for those who can afford those higher payments in the short term might make better sense. First, mortgage interest rates are projected to decline to 5.4% in 2023, and they will likely continue on a downward trajectory once the Federal Reserve starts to reduce the Fed funds rate. As mortgage interest rates hit low levels, that will come with an opportunity to refinance to those lower interest rates, just as many of the homeowners in the past have done over the last couple of years. Secondly, although the housing market is seeing price corrections in certain areas, real property appreciation does seem to be continuing. Simply put, they aren't making any more land. Land will always have intrinsic value and will thus generally increase in value over time based on scarcity. And this is especially true since the prediction is that the demand for housing will continue to increase, given that there are a lot of people who will soon be in need of a home. It's estimated that there are 50 million people in the 28 to 38 age range, many of which are likely to become potential homeowners in the future. For those under 35, the homeownership rate is only 39%, while that share increases to 61% for people aged 35 to 44 years old. So assuming affordability isn't an issue on monthly mortgage payments, the calculation for longer-term real estate investors is whether the near-term higher interest rates and the accompanying higher payments are offset or exceeded by the return on capital from the appreciation during the same period. For example, if appreciation relaxes to a more historical average of about 6% per year versus the double-digit appreciation that we've seen over the last couple of years in many of the hot short-term rental markets, then a mortgage of 3% over the most recent historically low rates still does not offset those appreciation gains. Now, for the conversational piece, does it make sense to get into the right house right now, even with the rates as high as they are? Do you view projected appreciation as a sure enough thing to get into the housing market right now, or let's say the anticipated rate reduction? I do expect this topic will divide some people, and that's okay. Just please make sure to keep it civil in the comments section, as we are all here for the same reason, to go further, faster financially. I do hope that you enjoyed today's video. One last point I do want to bring up is let's not forget the cost of a refinance. If you do get into a higher interest rate now with the goal of refinancing down the road, that can cost you an additional 2 to 3% in closing costs. So on a $500,000 mortgage, for instance, that could be anywhere between $10,000 to $15,000. That should be factored into your comments as well. What do you guys think? Also, don't forget to like and subscribe and share the video with somebody that could use it. Until we see you on the next one, I look forward to reading your comments below. Make it a great day today. Happy holidays, and don't forget, keep on cash flowing. We'll see you soon.